Do you know that there are people out there making millions of dollars every single year and are paying $0 in taxes? It's crazy, right? But it's true. And in today's video, I'm going to teach you exactly how the wealthy pay 0% in income taxes with tax strategy. How you too can learn some of the same tax strategies that they're leveraging to pay as little as 0% in income taxes. If you're somebody that has always wondered, how do wealthy people do it? Look no further than this video. I'll break down the tax code to you in a way that you can understand so you too can master the power of the tax code. Without further ado, let's dive in. Alright guys, if you're new to my channel, what you'll learn about me is I go directly into my videos. I don't like to put a whole lot of fluff at the beginning of my videos. I like to go directly into the sauce. And the sauce starts with rental real estate. For most people, the easiest way to reduce their taxes to zero is going to be through real estate investing. And this is because the US tax code gives real estate investors the best tax benefits. Of course, if you want to bring your overall tax burden down to zero, we have to work with the tax code and take advantage of the best tax breaks within the code. Now, you might be asking yourself right now, Karlton, this seems really random. Why would the government provide tax breaks for real estate investors more than business owners specifically? And if you're asking yourself this question, it's a perfect question to ask. The reason why is because the US government uses tax breaks as an incentive for certain activities that they want people to do. The US government wants people to invest in real estate more than anything. And this is because when people invest in real estate, it helps to provide housing to the US housing market. In other words, it helps to ensure that US residents will have places to live. If real estate investors did not invest in properties, then the US government would have to provide all of the housing in America, which it definitely does not want to do so. Instead, it gives tax breaks as a way to motivate people to become real estate investors and in return, create affordable housing. What this means for us is that we can actually become sort of like partners to the government in order to capitalize on some of these tax breaks. Here's how this partnership would work. We provide the housing and the government provides the tax breaks. Both parties benefit, and so do the people who end up living in or renting the units. It's literally a win-win-win situation. But what are the tax advantages of investing in real estate? There's many of them, so let's cover them here. In order to bring your tax burden all the way down to zero, we need to use a combination of several tax strategies. The first thing that you need to know is that real estate investors are able to deduct 100% of their investment property building. This means that if you invest in a rental property that has a building value of like $1 million, you would get to write off the full $1 million. But there's a catch. We'll talk about it. But unless you use other tax strategies, which I'll discuss later in this video, you have to claim depreciation over the course of 27.5 years for residential properties or 39 years for commercial properties, which means your $1 million gets spread out over time. Let's talk about creating a paper loss. The reason why being able to deduct depreciation is so important is because of something that I like to call paper losses. Depreciation can help you force a paper loss on the tax returns, and the value of your building can go up over time even though you claim depreciation. A house that's worth $1 million today may be worth $1.5, $2 million over the next 10 years. So by allowing you to deduct depreciation, the IRS lets you deduct the losses that occur on paper but might not actually occur in real life. It's called paper losses. The key to reducing your tax bill all the way down to zero is to maximize your paper losses. The greater number of losses that you have, the more you get to deduct against other income. However, in order to optimize your paper losses, we have to take advantage of another tax break for real estate investors. And this tax break is called accelerated depreciation. Remember when I said a few minutes ago that real estate investors can deduct the entire value of their rental property structure through depreciation over the course of 27.5 years for residential or 39 years for commercial? This is great, right? But the problem with that is that that's several years of time. Money that you could take in a deduction over 27.5 years would be better served if you could just take it now. Am I right? And that's how savvy real estate investors think. This is where accelerated depreciation comes into play. The United States tax code allows real estate investors to accelerate depreciation by using what is called the cost segregation study. A cost segregation study is a study that segregates the cost of your rental property into two categories: structural and non-structural. The structural components are the components that make up the actual structure of the building and keep it from falling over and tipping over. That's the steel, the wood beams, the foundation. The non-structural components are components that do not actively support the structure of the building. That could be like light fixtures, carpeting, appliances, those things. Non-structural components can be depreciated over a shorter period of time. And in fact, most non-structural components can be written off over 5, 7, or 15 years. So by using a cost segregation study, we can deduct a large amount of your depreciation for the first 5 to 15 years of you owning the property, which could help you create that big paper loss on your tax returns to help you reduce your overall tax bill. All right, let's talk about short-term rentals. You guys know I'm a big fan of short-term rentals on this page because I work with a lot of high net worth W-2 taxpayers. And guess what? We can accelerate depreciation on short-term rentals to help out the W-2 taxpayer. Let me explain. While the strategies I've discussed up to this point in this video are great, for most people, they will not be enough by themselves to completely eliminate a tax bill. And this is because for many people, real estate investing losses will only be able to be deducted against passive activities such as your rental real estate income. What this means is that unless you have the ability to manage your real estate for 750 hours and a majority of your income comes from real estate, it's going to be really hard to use real estate depreciation to offset your W-2 or your 1099 business. This is where looking at short-term rentals comes into play. Don't worry. There is a workaround for those who have struggled to get around these passive activity loss rules. It's called short-term rentals. You can get around the passive activity loss rules by using short-term rentals as opposed to long-term rental investing. According to Code Section 469, as long as the average guest stays in the rental are 7 days or less and you materially participate in your rental business, you can use losses from real estate investing to offset 1099 and W-2 income. So by investing in a short-term rental property and doing cost segregation study to accelerate depreciation, yes guys, you can reduce your tax bill as close to zero too. Now I know this is a lot of information, so let's look at an example to break this down. Let's say that you have a W-2 job and you're making $100,000 per year and your tax bill is somewhere around $15,000. In this case, you could buy one short-term rental with a building value of $500,000 using a mortgage loan and a down payment. Now, right off the bat, before we accelerate depreciation, you would be able to deduct about $18,000 with straight line depreciation over 27.5 years. However, we could implement the cost segregation study strategy and accelerate depreciation. By using the cost seg, we can increase your first year depreciation deduction by as much as $120,000, since it's common for a cost seg study in the first year to give taxpayers somewhere around 20 to 30% of their building value as a year one write-off. That $120,000 of accelerated depreciation loss could be used to offset all $100K of your W-2 income. You would be able to offset the additional $20K of rental income if you had rental income as well. This could bring your tax bill all the way down to zero. Now, we've covered a lot so far, and I know you guys are probably wanting to know a little bit more about real estate investing. I highly recommend that you watch this video right here to learn a little bit more about advanced real estate strategies to completely help you eliminate your tax bill with real estate. Now, as promised, I always go over subscriber questions right at the end of my videos. This one question came in from NM4011 on my real estate tax loophole video. The question was, what happens if you can accelerate depreciation, but then resell the property a few years later? Glad you asked this question. Anytime you accelerate depreciation, you want to make sure that you're aware of depreciation recapture. All this is the depreciation that you took in the year that you accelerated comes back to you in the form of income when you file your tax returns. If you don't want to pay taxes on a depreciation acceleration when you sell that property, what you could do is look at the IRC 1031 exchange strategy. Essentially what you're saying is, instead of just selling my property and taking the gains later down the road, I would rather sell my property and reinvest into another property that's at least equal in dollar amount or greater in dollar amount to the property that I'm selling. Because you're choosing to roll the capital gain into another property as a down payment, you're avoiding paying capital gains taxes when you sell the original property, executing a successful 1031 exchange. If you have any questions around how to avoid depreciation recapture, whether or not doing cost segregation studies is best for your circumstances, feel free to schedule a meeting with my team. We review this strategy all the time. We have other CPAs that challenge this strategy. We end up getting on the phone with your CPAs all the time, talking some sense into them, getting them to understand depreciation the way we know it. And then the next thing you know, you're buying investment properties and doing the exact same strategies. Who even knows? We'll help your CPA buy his first property if he doesn't own real estate yet. My name is Karlton Dennis. You know where to find me, somewhere buying real estate and accelerating depreciation. I hope you enjoyed this video. I know I did. You can do something for me. Like, comment, subscribe. You know what it is. I'll see you guys in the next video. Cheers.